Hello and welcome back to Investor Days with ABG. My name is Ofelia Aspemyr and I'm an analyst within the Renewable and Industrials team. With us today we have SinterCast CEO Steve Dawson that will start off with a presentation followed by a short Q&A. With that said, please go ahead, Steve.
Okay, thank you, Ofelia. Good afternoon, everyone. So our last presentation at this event was exactly 1 year ago. At that time, I explained our technology and our business model and our market opportunity. But that's not the story today. The story today is about 2020. It's about Corona. It's about our recovery. And it's about the effect on our long-term market opportunity. There's a couple of other current hot topics that I'd like to address today. Recently, there's been a lot of information about electrification and fuel cells for commercial vehicles and how that will affect our market opportunity. So let's focus on those two items today. If I could have the next slide, please. So for those who aren't familiar with SinterCast, we can begin with just a small introduction. We have developed a technology for the production of a new type of iron called compacted graphite iron. And compacted graphite iron is very good when you have applications with a mechanical load and a heat or a temperature load at the same time. And if it's only a mechanical load, you can find better materials. If it's only a thermal load, you can find other materials. But when there's a mechanical load and a thermal load at the same time, we have a very effective solution. And the main application where there's mechanical and thermal at the same time is for engines. So our core market is for the internal combustion engine. And when designers choose compacted graphite iron, they can make their engines smaller and lighter. They can push them harder to make them more fuel efficient and less emissions. So SinterCast, we don't actually make the castings. We are a technology provider. So we provide our technology to the foundries. They make the castings and ship them on to the car or truck companies. So don't think of us as a large manufacturer with a lot of people. We are a technology provider. Our first production started in 1999. And since that time, we've grown up to have 49 foundry licensees in 13 countries around the world. We produce well more than 1 million engines per year, and we'll do that even this year with the lower volumes. In the last couple of years, we've also developed a couple of new technologies for tracking and traceability in the foundry industry. But again, that's not really the story of today. That's still a relatively small part of our business, and I look forward to coming back and talking about that on another occasion. So let's go to the next slide, please. This shows our production over the last 3 years. We had a 19% growth in 2018, followed by 30% growth in 2019. And when I had this presentation 1 year ago, I said that our outlook for 2020 was to be a little bit flatter in the production. After 2 years of strong growth, we would be flatter. I didn't give a number at the time, but internally we were thinking something between 5 and 10%. But I also said that we would have a very strong year, a record year for new installation revenue. And we've been consistent with that all through the year. We've had a good year for installations, and I look forward to reporting on that when we make the final accounting in January. So we've been on a really good roll. I would like then to look in the next slide in more detail at 2020. And we see 3 distinct zones. So initially, we started out more or less at the same rate as we were in 2019. And that's normal that January is a little bit lower. We have the Christmas shutdown. Our largest producer is in Brazil, so they have their summer shutdown in January. So we started about 5% low. But then the Corona effect started. And some of our foundries closed in March. Most of our foundries closed by April. And we hit this low point of 1 million engine equivalents. Since that time, we've had a fairly consistent recovery. And you can see that in the last 4 months, we've been quite stable at around 2.8 million. So when we went down to 1 million, compared to our production of 3.3 million engine equivalents in 2019, we were down 70%. And I remember internally we had a management discussion probably in May, and we all had a consensus that we would be happy if we could get back in the high 2 millions before the end of the year. And so we're there. Are we happy? Not really. We're safely and solidly profitable at 2.8 million. But of course, it's a disappointment that our good growth has been paused and pushed out in time. If we can have the next overhead, please. Yeah, so here I would like to differentiate between growth and recovery. And you see that 2017 to 2019, we had this real clear growth with new programs coming on stream. Our year-to-date production so far this year, we're about 2.5 million engine equivalents, so we're down 25% on 2019. And if you just look at the last 4 months where we've begun to stabilize, we're about 15% below. But this recovery will continue. There's a lot of demand out there in the market. On the passenger vehicle side, there's not enough cars on the dealer lots. The car manufacturers are working hard to rebuild that inventory. The entire supply community is benefiting from that, and we will benefit from it. And that demand will continue well into next year. Certainly people in the industry talk about beyond Easter and into the middle of the year before things are caught up. That's the passenger vehicle side. There's also a really strong demand on the commercial vehicle side. So most of us have been staying at home. We haven't been going out and spending our money. So we stay at home and we buy stuff. And there's an analyst in America who said it really wonderfully. He said, a summer vacation doesn't fit on a truck, but stuff does. And so there's been a really high demand for commercial vehicle. In the United States, commercial vehicle sales in October were at the highest level for 26 months. And now we have a new development here in Europe where the German government and the EU are initiating a kind of a cash for clunkers program for trucks. So we're currently on Euro 6 emissions, and this program is designed to take everything older than Euro 5 off the roads. So the government will somehow finance the purchase of those old vehicles and the scrappage of those old vehicles for a renewal of the fleet. And most people in the industry think that this will make for a really strong commercial vehicle demand for the next 5 to 10 years. So the recovery will continue. We'll get back on the growth track, and we're really confident that we'll get back to our near-term horizon, which we said in our pre-corona statements of 5 million engine equivalents. Next one, please. So we can look at the production as well over a longer historical perspective, and this goes back to 2006. And what we see is a rather consistent growth. If you do the math to calculate the compounded annual growth rate, we are approximately 15%. It always depends on where you start and stop the calculation. But if you take any sensible point on this plot, we're running at about 15% growth every year. And if we can have the next slide, please, looking in more detail, we see that there are 3 dips in this period. We all remember the decline in 2008, 2019, and we went down 58%, and it lasted for just over a year. And then we had the European economic challenges in 2012-13. We went down 25%, and it lasted for just more than a year. And now, of course, we have the corona. And what we can see is that we went down 54%, and the initial recovery looks to be sharper. We'll just have to wait and see how that evolves. But the message of this overhead is that it happens. Yeah, it's a pity, but it happens. You come out the other side, you return to growth. If you've managed your cash box well, and we have, you can withstand these dips and come back to growth. So we're confident that this profile will return. We're confident that we get back to double-digit growth. And as I say, we can see 5 million engine equivalents in our near-term planning horizon. If I can have the next one, please. So moving from a review of our current production now to an outlook for the future, let's begin with our current production breakdown. You see that our passenger vehicle volume is about 60%, commercial vehicle is about 35%, and industrial power about 5%. And historically, for the last 5 years, that's more or less where we've been. Maybe trucks were a bit higher, cars were a little bit lower, but it's always been in that neighborhood. And then I want to break down the passenger vehicle production so we can really analyze our exposure to this diesel discussion. 67% of our passenger vehicle production is Super Duty pickup, so it means large pickup trucks with 6 to 7 liter engines. And this is really where the drivers want a diesel and the vehicles need a diesel. So this is really a safe domain of diesel. 20% of our passenger vehicle production is for petrol engines, so obviously not involved in the diesel discussion. And 12% is for 3-liter V6 diesels, which are used for luxury vehicle and sport utility vehicle. And it's reasonable that this will decline, but in total, it's approximately 7% of our production today. And even if it is reduced by 50%, it affects us by about 3%. So it will decline, it won't be difficult for us, and it will continue to contribute. In the next overhead, please, I'd like to try to make an attempt at painting the picture of a 10-year outlook for SinterCast. And we can do that with each of these 5 different categories. So the Super Duty pickup, there are 3 Super Duty pickup trucks in North America. SinterCast is used for 2 of them, for Ford and for Fiat Chrysler. So the third one is an obvious target for us. We see that over the 10-year period, this is a stable production with a growth opportunity. Our petrol engine has been growing in recent years. We also see that as stable with growth opportunity. It can be used in hybrid applications, and indeed it's used today in the hybrid engine of the Ford Explorer. The V6, as I say, it will decline, but it will continue to contribute. And then we come to commercial vehicles. And we've been really consistent for more than 5 years to say that commercial vehicles are our largest growth opportunity. And that's still the case. With the increase in pressure, the demands for fuel economy and fuel efficiency, commercial vehicle engines have to be pushed harder and harder. And that's always an opportunity for CGI. I have said before that I don't know how long it will take, but in the fullness of time, all commercial vehicle engines will become CGI. And that's what we see. We're not going to grow in this sector by an increase in commercial vehicle sales. We will grow by the existing commercial vehicles being upgraded to new CGI engines. And then finally, we come to industrial power. This is construction, agriculture, marine and rail. And this will also grow, but it's not such a big sector. When you make 400,000 passenger cars per year and you make 75,000 or 100,000 commercial vehicles per year, the volumes on the industrial power side are more like 5 or 10,000 per year for most applications. So it will grow, but it will always be the little brother. If we have the next one, please. And I'm just echoing again that through this growth, we're confident that we get to 5 million engine equivalents and that there's growth beyond that. We don't get to 5 million and stop. There's continuous growth. Okay, next one, please. As trucks are our largest growth opportunity, I'd like to spend a few minutes focusing specifically on the market development of trucks. And as I said in the introduction, there's been a lot of publicity lately about electric and fuel cell applications. I've tried to show here the 3 different technology paths. And when we say diesel, we don't mean diesel fuel. We mean the diesel engine. It can be fueled with conventional fossil fuel diesel or biofuel or synthetic fuels or other fuels. There's a lot. And the fact is that the heavy-duty trucking market today is more than 95% diesel. And there's nothing that can compete with it, not from an efficiency point of view, not from a driving range point of view, and not from total cost of ownership. So we see that the diesel engine will continue in heavy-duty trucking for a long time, and I'll show that in the next couple of overheads. As the new fuels come in, it will make it even more difficult. The diesel will become cleaner, and it will be even more difficult to displace it. Looking at battery electric vehicles, there was a lot of talk about that 2 or 3 years ago, and the industry is starting to distance itself from that discussion. The consensus is becoming that batteries will be good for final delivery trucks, short-range truck, last-mile delivery applications, but the energy density just doesn't seem to be there for the long-haul, heavy-duty trucking. So I think that threat, if you will, is less today than it was a few years ago. And we never really did feel the threat, but the hype is less than it was 3 years ago. That brings us to hydrogen. And I know that hydrogen is a fuel rather than a technology, but I said hydrogen here because it's not yet clear how the hydrogen will be used. Will it be used in fuel cell application? Or will it be used as a fuel for an internal combustion engine, like a diesel application? There's a lot of benefits for the hydrogen to be used in an internal combustion engine. First, the manufacturing facilities and the infrastructure is there, both for manufacturing and for service. There's a familiarity with the owners and the operators. We don't need exotic materials like lithium and cobalt and rare earths and even copper for charging infrastructure. And above all, the total cost of ownership. The most important thing to a fleet ownership is total cost of ownership. And a man in the commercial vehicle industry, he said to me many years ago, he said, people buy cars to spend money, people buy trucks to make money. And so they have to find the solution that has the best total cost of ownership. And at the moment, it seems very difficult for the fuel cell to compete with a liquid fuel in an internal combustion engine application. All of this boils down to the statement on the bottom of the overhead, which is related to the 2050 carbon neutrality, whether that comes from the Paris Accord or from the European Green Deal that's discussed more. And a part of that is that OEMs have to sell a certain number of zero-emission vehicles in 2025. And the most practical way to do that at this time is with batteries. So they'll just put more batteries into the truck and they'll sell it. They'll sell it primarily to local fleets, which can come back to the depot and recharge every night. But they'll do that and they'll meet the quota. But this is very much a technology demonstrator. It doesn't affect the overall market opportunity. Then we look out further in time, and the requirement is for carbon neutrality in 2050. And the math is quite simple. What they say is that a truck will last for approximately 10 years. So in 2040, we need to stop selling fossil fuel trucks. And this is really the question. What will come then? Will it be a diesel type engine hydrogen fueled, or will it be hydrogen with a fuel cell, or will it be something else? At the moment, it's not really important. There's a lot of development going on, and SinterCast is participating and supporting that development. But what it means is that change is 20 years away from us. We see a solid growth opportunity until 2035, probably to 2040. If we can look at the next overhead, I'd just like to show 3 quick examples before we finish. So this is a press release from Scania in 2017, where they announced that they're building a foundry. They're investing 150 million euros to build a foundry in Sweden. And this is a very long time investment. And that foundry is being commissioned now, and it will start production next year. And of course, it will have a very long lifespan. And the next one, please. Yeah, and this is another press release. It's from Volvo, also in our home market of Sweden, where they're investing 155 million euros in their foundry to prepare it for the future demand for engine castings. And again, this is a very long-term investment. And finally, one last example. This is related to hydrogen. It's in the next slide, please. Yeah, So this is a press release that just came out about 1 month ago. It's from Kiu, the company in Germany, which is specializing in converting diesel engines into hydrogen fuel. And their announcement, as I say, 1 month ago, was that the European Union has made an investment in their company to support the use of hydrogen as a fuel for heavy-duty internal combustion engines. So while all of the media attention regarding hydrogen is on fuel cells, we see here that the legislators, the European Union, sees a viability in the path for internal combustion engines and is even financing some of it. So it's a very positive development, and it helps to put it in perspective. So finally, in the last slide, if we make a summary, thank you. So we will recover to the 3.3 million engine equivalent level that we had in 2019. We'll return to double-digit growth. We'll grow to 5 million engine equivalents. There is growth beyond that. As we predicted last year, that 2020 would be a record year for installation revenue. It's been a challenge with the corona delays, and a lot of it is pushed into the fourth quarter, but we will complete those installations, and I look forward to being able to report on the final counting in January. There's a strong demand for commercial vehicles today. There's a confidence that will be a strong demand for at least the next 10 years. And we see growth opportunities to 2035 and beyond. So thank you. I hope that the summary and the update were helpful. Thank you.
Thanks a lot for the presentation, Steve. Some countries are considering bans of petrol and diesel engines in 2035 to 2040. How will this affect SinterCast?
Yeah, you're absolutely right. And as I say, it's partly a countback from the 2050 zero emission target. They reason that a passenger vehicle has a 15-year life, so they have to stop selling them in 2035. They reason that a truck has a 10-year life, so they'll stop selling those in 2040. But it gives us a long run of growth in the meantime. In the meantime, the engine performance will go up a lot. The pressure and temperature will go up, so it's an opportunity for CGI. You mentioned 2035 and 2040. Here in England, to my surprise, Boris made an announcement just last week that it would be 2030. You know that I'm presenting from my home in England. I'm 40 kilometers away from Boris. I thought he might have had enough on his table with Corona and Brexit. But he put that out at 2030. My guess is that he's got a lot of pressure, and it was a good news announcement. Somebody else will have to be in that seat and deliver it in 2030, not him.
Okay. And if we look at the historical figures for SinterCast, we see that the installed base of fully automated system have been fairly stable, and that the mining systems and tracking systems has grown at a higher level. What do you think about this if we look ahead?
Yes, it's correct. The tracking systems have been new, so we've sold 5 of those in the last few years. I said that we had 49 installations in the first slide. That was CGI installations. Then we have 5 for tracking, so 54 in total. Mini systems are easier to sell. They're an entry-level thing. You really only buy a big system when you have a production to offset it against. But this year has been really good. We had 3 big systems, WHB in Brazil, FAW in China, and Scania in Sweden. I would look at it a little bit differently. Historically, in the last 10 years, we've had 7 million of installation revenue every year. And I think that our outlook will be something between 7 and 10 for the next 5 years. And I'm not sure where it will come from, but whether it is mini systems, full systems, or tracking. But I think that 7 to 10 is probably where we'll be in installation revenue.
Okay. And in your latest report, you stated that you are developing new, interesting technologies. Could you please give some insights of what types of new technologies and in which business area this will be?
Yeah, so it's primarily the tracking technologies. I say to the employees that I grew up on the CGI side of the business, but I really love the tracking technology. It's a really clever new technology. In the old days, the foundry made a casting, and it was almost a commodity part. They were made in batches. And what our tracking technology does is that it changes each casting to an individual. So when that casting leaves the foundry, it has a complete production record of when the sand was made to mold it in, when the iron was made, when it was cast, how long it sat in the mold. Every detail of the production history is assigned to that casting. And if an OEM goes to the vehicle identification number on the windscreen and scans it in, he will know the minute that the casting was produced. So it's a really clever tracking technology. We hear a lot about Industry 4.0, and what Industry 4.0 really is that each product becomes an individual with a detailed production history, and that's what this is. It's bringing the foundry industry into Industry 4.0. Okay. I'll do that next time if you invite me back.
Yeah, of course. Thank you for the presentation, Steve, and thank you for your answers. We are very happy to have you with us and hope to see more of you ahead.
Okay, that's great. Thank you.
Thank you.
Bye-bye.